Hello all, welcome back for another video, and this time we're gonna talk a little bit about interest rates and bonds. I personally I'm kind of a sucker for learning new things about the economy and economic principles. I really enjoy studying about these matters and learning more and more because it actually helps me make educated decisions. So I really enjoy delving towards learning more and more things about economic principles. So in this video, I kind of wanted to talk a little bit about bonds for the most part, and I'm not gonna be extremely technical. I'm not gonna go into details about how bonds and coupons work and all that, but I kind of want to explain the idea behind bonds so that you can understand how they affect the market and what they really are and what they represent. So basically, um, let's talk about and I have created a whiteboard here, sort of like set up so that I can kind of sketch a few things. And I'm a terrible painter, obviously, but I'm gonna try to paint things or create some simple sketches here in order to showcase some of the ideas. So please bear with me. But so a very important thing to understand, and this is how I would like to initiate the discussion about bonds, is the concept of risk and gain. So generally speaking, as you would expect, when you are actually risking more, you are prone to actually receiving more, to actually gaining more. So generally speaking, the idea of risk going higher, and that's a terrible uh, sketch, I guess. Risk going higher. Um, Sorry, actually, that's not so good. Let me erase it. So the more the risk, right, the higher the rewards. So simple as that. So meaning that if I am to risk more of my money in order to gain money, then I would be expecting to gain more money for the money that I risk. For example, if I'm taking a risk of defaulting, like from going from $100 to zero, I would expect to have a higher interest rate. So I would expect to be gaining more money out of my 100. So I would potentially expect to get like a 10% interest rate if I'm risking my money on something that could potentially have me lose all of my money on that investment. So basically, the more I risk, uh, sorry, so the more I risk, the more I'm expected to gain, right? Now, bonds, if we're talking about a bond is basically pretty simple as an idea. So the first thing that you need to understand is that everything has a cost in this life, right? So let's say that I have a car, and my neighbor potentially asks me to to borrow my car, and this could come with me asking for something back. I require some sort of I demand some sort of payment back for what I've done for them, right? So I give them my car, so I demand some sort of interest, some sort of a gain for myself because I actually gave an asset to them, so I am expecting some sort of a return, right? And that only makes sense. So let's say that somebody is selling some oranges. So picture that these are some oranges, not the best oranges in the world, but let's just say that these are some oranges, and somebody is actually giving them to somebody else in return of for yeah, apples, let's say. So these are apples. So for example, I'm giving three oranges for two apples, and that's like an exchange. So I'm exchanging some fruits. I have three oranges, and I'm willing to get two apples for them. Now, this is very simple to understand. I mean, everybody has a demand, and uh, we are kind of balancing out those demands. And let's say that in order for me to sell you, like, I don't know, like a guitar, for example, I demand some sort of a payment back. Let's say that if we're talking about products, let's say that I wanted a lot of food, for example. This could have been like flour and pasta or whatever, and would probably be in higher proportions. And that's an economic thing. Like, how much do you value a guitar in comparison to food? But what about money? So let's say that I have $10,000, or let's say $100, just for simplicity's sake. So let's say that I have $100, right? And somebody comes to me and says, "Look, I want to borrow your $100, and I'm going to return it to you in 10 years." So, so somebody says, "I'm going to borrow this money, I'm going to return it to you in 10 years." So this money today is worth $100. Generally speaking, money 10 years from now is gonna go worth more or less, you'd think. So obviously it's gonna worth less, right? Because of inflation. So inflation tends to be like 2 or 3% in developed countries like the US, for example, mostly around 2%. But this basically means that every year your currency loses 2% of its value. So when I'm giving you $100, I'm expecting some sort of a return, right? I'm borrowing you some money, and so I'm sorry, I'm lending you some money, so I'm expecting to get some return from you. And this is what we're calling the cost of capital. So $100 is actually capital, right? It's considered capital, and it is capital. It's it's $100 that can be used in the real economy. And so in order for me to lend you $100, I should have something in return. And for this reason, we make an arrangement. We make a mutual agreement, and we're like, okay, for the $100 that I will be giving you today, you're gonna be paying back some interest. And so let's say that the interest is 5%. And this means that every year I'm gonna the person who actually borrows the money is gonna pay the lender 5% on the capital, which is $100. And we're going with the assumption that the capital is fixed, which is gonna be $100, and it's not gonna be compounded over the years. So in this case, in 10 years, basically every year you're going to be getting 5%. And so the first year you're going to get $5, right? That's year one. Year two is going to be another $5. And year 10 is going to be another $5. So basically, in 10 years, this will amount to something like 10 multiplied by $5, which is basically $50. So in 10 years, you're going to be gaining pretty much 50% in total, like 5% every year, so 50% in total. So the cost of capital in this situation would effectively mean that for me to lend you $100, I would need to give 50% back over a period of 10 years. So that's the simple idea behind a simple the cost of capital and the cost of money, really. Now the like corporations and countries have an easier way for people, and a nice way, supposedly nice if you like it, to track these kinds of loans, because corporations and countries do require capital for various situations. I mean, they want to expand, they want to be creating, I don't know, bridges, whatever, paying their employees. So they need capital. Everybody needs money these days, right? So in order to raise capital, let's say, let's picture a country. Let's say this is a country, and let's say this is the US. So the US is issuing some government bonds. These are called government, it's tough to type here, but okay, government bonds. And a bond, basically the way it works, and I'm gonna be simple here, it has a face value. Let's say it's $100 in this situation. And somebody who buys that bond, let's say that I am a person, an individual, and I'm buying a bond. So I am buying that bond, I'm paying for the bond, and now I own the paper. So what I did here is by buying the bond, I pretty much exchanged my $100. So I had $100 in my pocket, and I exchanged it for paper, basically, right? So I got some paper. I got a paper, a bond, as it's called. So this paper has some value because the U.S. government backs it up. So if the U.S. government wasn't there, this would basically be just a paper. It wouldn't mean anything. It wouldn't mean anything. But by virtue of being created by the U.S. government, this has some benefits. And for this specific situation, this bond, let's say that this was, again, this is like $100 bond. And let's say that this is a bond that would expire in 10 years. And I'm going to explain what that means. 10 years. So this by bond expiry we mean this. So when we buy the bond, this costs $100, and the only way to get our capital back is when these 10 years is by when these 10 years pass. So once you get a 10-year bond, you have to expect for 10 years to go through to pass in order to get your capital back, your initial capital back, your $100. In the meantime, you're going to be gathering the interest. So in the first year, let's say this was the current interest rate in the US market for the 10-year bonds is, let's say it's 3%. That's for the 10-year bonds. And so every year you're basically going to be getting $3. So $3 first year, plus $3 second year, plus $3 third year, and so on. So at the end of the 10 years, you're going to be getting $30 on top of your 100 and plus your $100. So in the end of the 10-year period, you're going to have $130 back. And this means that the cost of capital for your situation was $30 for locking your capital, $100, for 10 years. So you effectively gave $100 to somebody, and you actually have evaluated that you needed to get $30 back for your risk in this situation, for the risk that you had to actually give money to somebody else, because you actually gave money to somebody, right? So the thing is here, how does that risk get evaluated? So if you are lending money to a government, let's say in this situation, let's say we have the US government, right? So the US government, in terms of risk, is a very, very low risk entity. So you wouldn't expect the US government to default. It has never happened in the past. And I don't know, it may even have happened, I'm not sure actually. But the point is that eventually the bondholders would get their money back one way or other. For example, by the US government can actually cut some more money, for instance. They can actually create money. They can create dollars and eventually potentially pay back their bondholders in very, very dire situations. Yeah, that would potentially mean some inflation, but the idea behind it is that there's very, very low risk because the US government is basically an entity that has capital and can create capital as well. So it's considered the pretty much the lower tier in terms of the lowest actually tier in terms of risk. It's the less risky investment. Now, as we're traversing through countries, not every country is the same. And if we go to Greece, for example, the interest rate that Greece would pay would be higher because of higher risk. So Greece would, if let's say that the 10-year bond would be 3%, 3% yield in the US, In Greece, it may have been like 6% because of the risk of default, which is much higher in Greece. And going lower after that, there's also like corporations. So, for example, picture Google. So Google can also create bonds, as where they're called like corporate bonds, and these bonds will also be paying out some amount, some interest. And typically, it's gonna be more than the U.S. government, of course. So it may be, I don't know, like in this situation for a 10-year bond, like 4.5%. And why would Google be willing to pay more than the US government? I mean, basically, the US government is baseline for everything. And this is why the interest rates of the US government are extremely important. And when the US government is willing to pay, when the US government is willing to pay 3%, this means that other corporations, in order to compete with that, they should be paying at least like 3.5 or 4 or 5%, right, of interest. Otherwise, why would I, as an investor, or as somebody who actually wants to make some interest, lend money to Google and not lend them to the US, right, to the US government? Because the US government is generally has way less risk than Google. And you may picture Google to be like an invincible company, but no company is invincible, and companies do default. While countries are much harder, it's much more unlikely for countries to default. So, getting a country's bond is actually much more has much carries much less risk than getting a corporate bond, for example, or a municipal bond for that matter. So that's the core idea. Basically, with a bond, you have to remember that you as an individual are actually lending money to the government. That's as simple as that. Now there are two important things about bonds, and as we said initially, a bond is basically a paper, and let's say that it has a value of 100. So the most important thing is the initial value of the bond, and also the other important thing is the current interest rates market, pretty much the environment, as we should say, the interest rates. Now, interest rates in let's picture that we're talking about the US, right? So we're talking about the US bonds in this situation, US bonds. You have to apologize, my sketch is here not the best. So let's say that, yeah, that we're talking about the US bonds. So delete that. So um, let's say that when we bought this bond, the date we bought it, the interest, and this is like a 10-year bond, 10 years. Oops, too many S's. So this is a 10-year bond, and when we bought it, the interest was 3%. Now, this interest actually also calculates the risk for um, for things going wrong with the U.S. economy at that time, right? So the inherited calculation of interest rates has a lot to do with how the U.S. economy is doing. Like, what is the risk of it going worse, or instead of growing, actually subsiding? So this interest rate actually reflects the risk for somebody to actually buy a bond and to lock their money for 10 years. So let's say that we bought this in 2018, this year, and we are 2 years in, and now it's 2020, and there is turmoil, and things are going bad in the economies around the world. And so now, because things are going bad in the economy around the world, things are kind of going bad in the economy in the US as well. So there starts to be some unemployment, less jobs, and corporations are not doing very well. People don't have a lot of money. There are layoffs and all that. So um, now the interest rates, because of that risk, because of the US economy is now much riskier, they actually go higher. They are 5%. because it's actually more risky to own a US bond because the US government is not doing well. So me as an individual, I'm actually amassing more risk by actually buying bonds. So at that time, in 2020, the bond hasn't changed. It's still $100. It's the same face value as it's called. That's like the face value of the bond. However, what has changed is the amount of money that I'm getting back from my investment. So initially I was getting 3% in 2018, and now I'm getting 5%. So as an investor, which one would you like to be? The person that gets 3% or the person that gets 5%? So obviously you would like to be the person that gets 5%. So you'd like to get the bond in 2020 instead. So what about the person who got this bond in 2018? So now this kind of bond, which is still ongoing, I mean it hasn't expired, right? So it expires in 10 years. So it's going to expire in 2028. So it's still an active bond. So it can be traded in the secondary market, as we say, the bond market. So the thing is, this bond in the next 10 years, it's gonna amass $30. That was the initial thing, $30, right? But this year, in the next the next 10 years, is gonna amass $50. So it's actually a more valuable situation here to get this bond for a 5% locked interest rate. This means that the older bond now costs less. So if somebody wants to buy it, they can actually buy it for less money. So this initial bond, let's say this is A and this is B, bond A and bond B. So now, if I wanted to sell my bond, because for example, I require capital, so all of a sudden something happened in my life and I actually require some money back, nobody will actually be willing to buy it for $100, right? Nobody will buy it for $100. There's no way I'm gonna get $100. Why? Because somebody can actually buy today's bond in 2020 and actually gain 5% interest for the next 10 years. And so this one is actually giving you a locked 3% interest for the next 10 years. So this costs less. So in the secondary market, maybe somebody will come back and say, okay, this is gonna make me $30 instead of 50. So I'm for the next 10 years. So I'm actually willing to give you $70 for this bond, for bond A in this situation. So you see how the bond market basically works, right? I mean, it's a relationship between the face value of the stock and the interest rates. How the market of the bonds is moving is really dependent on the interest rates and what happens in the economy. And the same basic idea happens also in not only countries but in corporate bonds, municipal bonds, and all that. Because everything is a small ecosystem that can potentially go bankrupt, right? A company is a small ecosystem and it can go bankrupt. It has inherited risk, and so this kind of risk reflects the values and the values of bonds, and this value changes over the years. So that's why it's extremely important to understand that how the interest rates actually affect the bond value, and how that value is actually circulating through the economy, and what a secondary market can actually do around this. Very, very important to understand these ideas. So if we actually let me actually erase the page here. So that's why, for example, it's kind of important to, when we're actually talking about the bond market. So let's say this is a bond, right? And this is a stock. And let's say this is a stock. Now, the bond is actually fixed income, right? It's fixed. So every year is going to be, let's say, 3% for the next 10 years. And the stock, let's say, that pays 2.5% in dividends. But there is a very important difference here. So dividends and stocks basically have two other aspects. First aspect, there is appreciation. So there is stock appreciation. The only way for a bond to basically appreciate in this situation is when the interest rate actually goes down. So interest rate goes down, value of the bond goes up, and that only will take effect if you actually sell the bond. Otherwise, it won't matter. You are still getting fixed money back, right? And basically the same with the stock as well. So, however, the second point, which is also very important, is dividends and dividends and dividend growth, especially dividend growth. And I did create a video and a completely separate video about it. And it's extremely important because you can be starting with a 2.5% yield here, which is basically the initial yield. And over the years, because a company, let's say in the next 10 years, because we're talking about a 10-year period here. So in the next 10 years, the company is actually appreciating. So let's say that this started with a dollar per share on the first year. And on the second year, it became 110. The third year became 120, and moving on. So you see that this is not fixed income. This is actually variable income. And generally speaking, if we're talking about big companies, it tends to go up and up and up. And so, which one of the two is more lucrative? You would think. Which one is more interesting in for investor? Which one for an investor in the current environment? You would say the stock, right? Basically, the stocks right now in the current environment, and that's because this also has to do with the exact current values. Because right now we're approaching. You have here like the 10-year Treasury yield is like 3%, right? Approaching 3%, and it has actually surpassed that. But let's say that with a good dividend yield stock, let's say that you have Procter and Gamble, for example, PG. That's the Procter and Gamble ticker name. Let's say that you are getting, I don't know, like 2.8, whatever it is, something like that, 2.8% in dividends, right? Plus the appreciation of that, plus the appreciation of dividends, which is like the dividend growth. And here, this basically remains the same. This is always 3%. 3% every year, 3% every year, plus 3%, plus 3%. So, and the only way for this to go higher, it's by if we're talking about the face value of the bond, right? Which costs $100, is for the interest rates to go down. So if it goes 2%, so if the interest rate goes 2%, then maybe your bond is actually worth 130. I don't know. Depends on the secondary market. But this is also a very, very risky proposition because right now the interest rates are already low. So you wouldn't expect them to go lower, but eventually you would expect them to grow higher, and that's why the bonds are actually not very attractive at the moment. Now, if we are talking about bonds that had a yield of 5%, things would change because a fixed yield of 5% can actually compete with the current situation in stocks, especially in an environment where the stocks are actually not growing higher and higher as they are doing these years. A 5% here would make a difference, definitely. It's not the same as 3. So that's the idea behind bonds. I tried to make it as simple as possible. I don't want to go into too many details about how bonds are paid and all that because I don't think it matters that much. If you really want to take to know how the coupons work and how they are paid, you can always find this information online, and I could potentially also create another video if you really want to. But the important concept that I wanted you to grab here is that basically a bond is a loan. You are lending money to somebody, by buying the bond. So it's a little bit counterintuitive because you're buying something in order to lend something. So you're buying a bond. So you're buying, let's say, 10 bonds of $100 each, and this basically means that you are actually lending $1,000 to somebody, $1,000 lending to an entity, and no, for the most part tends to be U.S. banks, U.S. not banks, sorry, U.S. governments, U.S. government, or U.S. corporations, for example, corporations, or it could be municipal bonds, for example. Basically, yeah, again, a bond is an easy way for tracking loans. That's what it is. It's an investment vehicle for tracking loans. But yeah, this is how it works. It's um it's a chart between interest rates and face value, and risk is extremely important in the valuation of interest rates, and so this is how the face value of bonds gets reflected in the in the price. And yeah, that's pretty much what I wanted to talk about in this video. Let me know if you had any questions, or if something wasn't that clear. Again, I'm not a professional, I'm not an economist or anything of that sort. I just enjoy these topics, and I'm trying to learn more about economics and finance myself. So really like talking about these things because it actually helps me grasp the concepts better myself as well. So yeah, let me know if you liked the video and what you'd like to see next. Hopefully my sketches were not that terrible, although they were kind of bad. But at least I hope that the video was kind of helpful for you, and it was easy to understand. And yeah, let me know, and please leave a like if you like the video, and I'll see you soon with the next video. Bye bye.